Hello guys, welcome back to the daily life of a day trader. Today I'm going to show you how to identify a fake breakout in the market. So I'm not going to bore you with a lot of talk in this particular video. So let's get down to business and I will show you how it is, how to identify it, and how to avoid it entirely in the market so that you won't lose a lot of money. So this particular chart is a chart of a DXY in 4 hours time frame, and we are going to use it to explain this. So let's start with understanding the structure of the market. If you look at this chart, you can see that it is obviously in an uptrend because it is creating a higher high, higher low, higher high. All right. Now, this being noted, but our point of concern is this particular area that we have this channel. Right. This channel is creating a kind of retracement in the market. Now, before we look at this particular breakout that we have here, I want us to look at this particular movement from here to this particular point, because there are a lot of things that you need to take note of in this particular run from here to here that will help you to avoid this particular breakout here, to know that it is fake breakout or re-breakout. Now, when you look at this movement here, you can see that we have a fair value gap at this particular point, and between this particular order block and this one, we have another fair value gap here. All right, taking this into consideration, then let's get back to this particular channel that you see here. Now, if you look at this particular channel, when the market broke this trend line with this bullish candle, all right, aggressive traders would have entered this particular trade at this point. Let me show you what aggressive traders would have done. Aggressive traders would have entered this trade at this point. Okay, placing their stop loss just below this particular level, and their take profit probably just above this level because the market is creating a higher high and a higher low. The market is in an uptrend. Okay, now I will go down to hourly time frame to show you that many traders would have entered this. Not even only aggressive traders, even those that would wait for a retracement, all right, a retest on this particular trend. Let's get down to hourly time frame and I'll show you something. Now, on hourly time frame, as they usually teach, let me just shift this a little bit. As they usually teach, once the market break the trend line and a candle closes above it, you are free to enter it because it is a breakout. Now, imagine that after the closing of this particular bullish candle, you jumped into the market, or you jumped into the market, right? Entering the position at this particular level, place your stop loss here, you would have been taken out at this particular point. Okay, now let's look at those that would have waited for a retest. Now, the market came back to this particular trend line, right? When it came back to this particular trend line, it looks like it rejected this particular trend line and created this bullish candle. So many people would have entered the trade immediately this bullish candle closed, and getting into this particular trade when this bullish candle closed. Now this is what would have happened to you. You would have lost this particular trade. Now I'm going to show you the reason why you shouldn't have entered the trade at this particular point as an aggressive trader, or entering the trade here thinking that this is a kind of a retracement in the market, like a kind of a retest of the trend line, sorry to say. So I'm going to go back to 4 hours time frame and then we explain better why. Now, coming back to 4 hours time frame, looking at this particular channel created here, there is something that you need to take note of. I want you to look at this particular point and this particular point. Let me mark it out. Now, if you look at this point, you can see clearly that this is a kind of rejection and this is another rejection. When the price first came to this particular level, many buyers entered into the trade considering this particular order block here, believing that the market will continue to go up to take out this particular high, which failed at this particular point. and then the market returned again on this particular line. You can see many people will consider this as a strong support level, and many buyers would have entered the market again. And also, considering this particular breakout here, there is a lot of confirmation for many traders to be in this particular trade also here to continue going up. But as a smart trader, when market gets rejections like this at a particular point, you shouldn't be considering it as a strong support level. This is liquidity building up here, more especially when you have a fair value gap below it. So there is a business that the market has to conclude just below that level. So that's why I said that you wouldn't have been in this particular trade. You wouldn't have considered this as a real breakout. All right, because you have a lot of liquidity lying below here. There are a lot of stop losses lying below here that the market will definitely come back to sweep out, and that is exactly what happened. So now let me go to 1 hour time frame and show you what you would have done instead of going bullish. What you would have done. All right, let's go to hourly time frame. So in hourly time frame, taking note of this in 4 hours time frame, you should have been expecting the market to come back to this level to sweep out all the liquidity side that is lying here, and also to fill in this particular fair value gap at this point. Now that is why you would have considered this. You would have considered this. So when this particular movement happened, this impulsive movement, this candle that run this way, it broke this particular structure. This is a breakout structure, all right? And then the market returned into this particular bullish candle that you are seeing here. This bullish candle that many traders would have considered as a retest. This should have been your confirmation, all right? And that should have been where you would have entered the trade. That is exactly where you would have gone short, taking position at this particular point and placing your stop loss just above it, all right? And placing your take profit just inside that particular fair value gap, inside that particular fair value gap. This is exactly the trade you would have taken, not the other way around. So this is how to trade smart, all right? You need to consider what happened when you are trading a channel, right? You don't just jump into, when you see a breakout, you don't just jump into it. You need to consider what happened within the movements that created that first run. All right. If there are clues that are showing you that this particular breakout is not real, there are some places to be visited. You don't need to see that particular breakout as a real breakout, because obviously there are unfinished businesses that the market needs to reach to before it continues its direction. We still have unfinished business here. Today is Monday, and we'll see how it goes. All right, this is how to trade as a smart trader and how to avoid fake breakouts. So if you find this video useful, please do well to click the like button and also the subscription button to help us grow this channel. We have other videos on this channel. You will see it, and I want you to watch them and increase your probability of becoming successful in the market. Remain in the channel and remain profitable.